Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Over a 30-year career in markets, Vadim Zlotnikov has gained a strong appreciation for the value of time horizon in risk management and alpha generation. Noting that being sufficiently early in expressing a view on markets is not much different from being wrong, Vadim stresses the importance of implementation in achieving a successful outcome. Here we talk of trade construction that is not necessarily burdened by high carry costs. We also discuss the endogenous nature of many market risks, an area that Vadim has focused on considerably and has developed a view that crowding plays a role in market vulnerability. Now the president of Fidelity Institutional Asset Management, Vadim is highly focused on portfolio construction and the exposures that should comprise the strategic allocation of the firm's clients. In this pursuit, he's thinking about the mix of assets that, in combination, is diversifying and able to deliver attractive returns. In this context, we discuss the changing interaction between risky and risk-free assets and the need to include additional sources of diversification, including strategies focused on commodities, long-short equity, and potentially digital assets. Lastly, Vadim shares some of his thinking on the importance of diversification through strategies that have unique time horizons. Here he makes the point that the alpha generation found in value investing takes place over a much different time horizon than does that alpha that accrues from momentum-based strategies. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Vadim Zlotnikov. My guest today on the Alpha Exchange is Vadim Zlotnikov. He is the president of Fidelity Institutional Asset Management. Vadim, it's great to have you on the podcast today.
Thank you so much, Dean. Love your podcast, so really appreciate being invited.
Looking forward to a conversation with someone who's got a job managing a couple of dollars here and there and has been in markets for quite some time. So what I'm hoping to do is get a little bit of history and background on your path to where you got to, and then really dive into some of the really interesting questions that we're all posed with now in terms of managing portfolios. So why don't we get it started? Tell us how you emerged in the business of markets in Wall Street. Tell us about the early days for you.
Sure. Honestly, I ended up in finance by sheer accident. I was born and raised in Kiev. I came to America becoming an engineer. Didn't really like it, ended up in management consulting. And then my boss married an executive recruiter and opened up an opportunity for me and identified an opportunity with Sanford Bernstein, where I started off on the sell side following technology. And partly as a process of self-discovery, I realized I really enjoy looking at things on sort of top-down basis. And so I evolved from being an analyst to becoming a strategist, portfolio manager, and then doing a business.
And what was that time frame in terms of when you got started in markets?
I think I'm celebrating roughly my 30th anniversary. Actually, almost exactly. In February of 1992, I started on the sell side at Bernstein.
Well, that puts you right about the same time I got started in markets. I started in Nomura Securities in late 1991. And what an interesting and different time. I'm just recalling that the funds rate was pushing 5 or 6%. Long bonds yielded 8%, and inflation was 4-ish%. So a much different set of prices these days, which it'll be very interesting to get your take on. So you've been at it for quite some time, and you've seen a lot of movies just with your technology background through the tech bubble, the original tech bubble of, call it 96 to 2000, 2001, the great financial crisis, and a lot of mini risk episodes of some consequence as well. It'd be great to just get some of your perspective, Vadim, as you look back on this 30-year career, some of those periods, whether they're cycles or market surprises or accidents that have just held a lot of consequence for you just in terms of shaping how you think about risk and reward.
Yeah, I think one of the most painful lessons that I've learned is there is really not much difference between being early and being wrong. And even though one can have a long horizon strategy, particularly on the sell side, I think it's certainly less true for longer horizon investors, but on the sell side, the ability to sort of get the turning points right. If you're early and you incur very high carry for being wrong, it's essentially just being wrong. And so timing and time horizon of your insight was certainly something I found to be extraordinarily important, and it's something that I've been sensitized to. So being clear and transparent about the horizon of your risk management, about horizon of your alpha is absolutely critical. And the second part that I really been more of almost a hobby of mine through the ages is the notion of the endogenous risk associated with common wisdom or crowding. And the reason it's such an important concept to me is because the drivers of capital flows evolve over time. Today, it could be partly ESG. In '89, it was the fact that Japan was going to dominate the world. And those ideas, those common wisdoms and the FANGs, of course, the tech bubble, the fact that technology spending breeds productivity, and then productivity means that people are going to continue to buy more tech. And therefore, it's a virtuous cycle that will never end. So those ideas are embedded in our microstructure. They are embedded in the common wisdom of the investors. And they change from cycle to cycle, but they create what I term the most hidden risk in the market, the endogenous risk associated with crowding, and focusing on that, identifying it, quantifying it, being aware of it, I found to be critically important.
Yeah, there's so much there, and so much of that resonates with my own thinking about the uniqueness of market prices. Market prices, in some ways, they don't react to us, we react to them. And it really is a sort of inversion of the cause and effect. And it almost seems that, especially when market prices prevail for long periods of time, they just color our belief system. Mm-hmm. Again, through your period of, let's just say, the tech bubble, and especially with your background on the single name side in technology, boy, the narratives that came up at that point in time as PEs elevated to 700 plus, if there was E, right?
Yep.
They demand an explanation. Perhaps it's the new normal, it's new business models and so forth. And a similar sort of thing, of course, happened in the presaging of the global financial crisis and the housing bubble. We were all told about how valuable real estate was and so forth.
And also the great moderation. And it was so logical. The pooling of labor pools, the pooling of credit risks, the diversification, all those concepts were real and they were commonly acknowledged by academics and practitioners.
Right. And in markets, we have this need to ascribe cause and effect. Markets have to make sense to us. And sometimes these prices can prevail for very different reasons than fundamentals. I want to go back to something you said, which really caught my attention. And that's on this notion of being early, too early, and essentially grinding it out and absorbing too much of the carry costs on an early basis. And so if we think about subprime and that period leading into subprime, there were a certain number of investors, of course, that perfectly nailed the timing and the implementation and the leverage, Paulson, the greatest trade ever. There were others who had the trade right early on, but got literally carried away in the sense of not wanting to pay the negative carry and wound up layering in all kinds of other structures that ultimately was not just not beneficial, but nearly took them out. One of which is this Morgan Stanley trader who had the subprime trade right and sold a bunch of super senior protection to try to fund it. And that came back to bite them. Tell us about the idea of getting trades right versus the implementation of the trade. You seem to have some very strong views on that.
Yeah, Dean, and you've mentioned this in the prior podcast, and I completely sort of agree with you. The actual insight that the subprime is an area of excess was not unique. It was actually quite broadly held. When I was on the sell side and talked to hedge funds and money managers, the fact that we were talking about it was pretty common. However, it was really interesting, right? There were a couple of different schools of thought. One was that it was going to be very narrow, that it only is going to affect those companies that are like mortgage insurers, etc. And then the other group said, well, but it will go on for a long time because the demand for yield and et cetera, et cetera. I completely agree with you. So the one example that I would give, and you've touched on it with the super senior tranche, but I was with a very, very well-known money manager, and we were talking about subprime. We were completing each other's sentences. It was beautiful. And he put on a trade whereby he wanted to go short a lot of the subprime exposure, but he wanted to just have a little bit of a balancing so he doesn't have to incur a very large carry. So he took some of the safest exposure he could find, which was Fannie and Freddie. He basically then vol-sized them, so they were not volatile, so he had to put in enough of them to make a difference. And needless to say, did not actually make any money on the trade despite being precisely right on the timing and precisely right on the logic behind the trade.
I think today's analog is probably the folks that had this view that inflation was set to rise, that the Fed's average inflation targeting methodology was just wrong place, wrong time, and that there was an opportunity to make some money on this notion that inflation was going to rise. And so they did things like payer swaptions or just paying on swaps, getting short the 10-year, the 30-year. And while that's started to work recently relative to the move higher in inflation, it's woefully underperformed. And so it seems a similar dynamic.
Absolutely. And this one actually probably, I would argue, lasted longer. I can remember people talking about reflation probably as early as 2009, 2010. So that would have been a very long negative carry.
Well, tell us a little bit about your role at Fidelity. It's a giant complex, and so it's not as if I would assume a firm of that size has the capacity to just shift on a dime. You talked about time horizon, and that seems to be an area of focus for you. Tell us a little bit about how you're thinking about Fidelity in the institutional asset management space, and then maybe we can weave in some of your thoughts on time horizon.
As the president of the institutional asset management, and looking at my client base, many of them have extremely long time horizon. For example, target date funds that have horizon of 20, 30 years. And in fact, the vacillation changes sort of month to month really are not that critical to the final outcome. However, you have to incorporate a couple of things. While they're not critical to the end outcome, they are critical or important to the investor behavior. So you want to essentially make sure that the volatility of the outcome, the ability of people to see their performance sort of month to month doesn't scare them to the point where they exit at the wrong time. And at the same time, you want to balance that off with a strategic allocation that actually delivers the type of outcome that investor seeks. And this idea of strategic allocation is very far away from trivial. It's not something that is often discussed because it's not exciting. It's not the theme du jour, but it drives 95% of your outcome. So it's actually far more important in most cases than alpha. And yet it gets relatively low recognition in the marketplace because it's complicated. So for example, should you have a high yield as part of your strategic allocation? Should you have commodities as part of your strategic allocation? Meaning if you have that 20 to 30 year horizon. Is it diversifying and is it additive to your return? And this notion of what provides for that persistent diversification and has a positive risk premium is an incredibly important challenge. And that's an area I do spend a fair bit of my time on. For example, evolution of crypto. Should you include it in your strategic allocation, et cetera, and so forth. So that's a big part of my job. And the second part that's probably even more important is the notion of governance, risk management, oversight, making sure that there is a congruence between what we're doing and what we have told the clients we will do. And there is a consistency with the expectations on the part of the client as to the outcomes of their investment portfolio.
This is a really fascinating time for the overall concept of portfolio construction. It just seems like there's more at stake now than there has been for quite some time. And I think, and you tell me how you look at this, but I think some of this boils down to new questions around the future efficacy of the 60-40 portfolio construction. For so long, we had this magic called duration, where you have this risk on, risk off environment, and you have a positive carry asset that essentially diffuses some of the vol in the equity side of things at exactly the right time. There's nothing to say that that can't return, but it's certainly been a bumpier road, I would say, for the last year and change. If you look at just days of when the S&P and let's say the TLT are both down together by a reasonable amount, of 10 times that a certain threshold has been hit, and I want to say it's down 1.5% at the same time on the same day, 6 or so of those are in the last year. And so it's certainly happening with much greater frequency. And I can assume, and I'll let you run with it from here, just from a risk management standpoint and portfolio volatility control standpoint, these are new and maybe vexing questions. How are you thinking about it?
You obviously raised one of the single most critical issues that is facing a 60/40, right? Or any sort of stock bond portfolio where bonds are expected to offer significant diversification. Now, the fact is that has been very much the case since 2003. Now, prior to that, the record is somewhat more mixed. There were periods of zero correlations, but there were also periods of meaningful positive correlation. And they've tended to correlate, that positive correlation in between stocks and bonds tended to go up in periods of rising inflation. So the fact that it's happening recently is not real surprise. So that's one side of the story. And what's the conclusion? Well, you have to think perhaps more aggressively and perhaps be willing to take more of the risk in looking at other sources of diversification for the 60/40. Now, we've seen perhaps a decade where some of the liquid alt strategies have been completely out of favor for reasons that we kind of know. And some people have gravitated to privates to try to find some of that diversification. But I think as we look forward over the next decade, that ability to continue to include additional sources of diversification, be it commodities, being long-short strategy, being a variety of strategies, I think is going to grow in importance over time. The other part that is sort of embedded in this, one of the most challenging times for multi-asset or 60/40 portfolio is an environment of rising real rates. And this is where you probably are facing one of the greatest uncertainties going forward. One can easily envision a scenario where inflation rises or stays high, but the real rates stay negative. And it actually is a positive for the capital pricing. And trying to figure out, can the Fed actually raise rates and actually incur significant financing costs? Or are they kind of stuck in an environment where they simply cannot raise rates to the point equal to the nominal GDP growth, which historically has been the case? That is an incredibly important controversy that we're trying to get our arms around.
Well, let's go back to the time horizon for Fidelity and the assets that you oversee, assuming that, again, you're not in a position to trade every headline by any stretch. And so you want to be as macro aware as possible, but you also don't want to engage in too much of the noise that seems to come at you. What's the balancing act there of, for example, incorporating perhaps the history of Fed hiking cycles, but not getting too caught up in the back and forth that is the nature of today's asset prices?
Almost everything about Fidelity is really about long-term. It's about delivering long-term investment outcomes. So the way that we approach it, the way we think about it, is to effectively stress test our allocation and stress test portfolio construction with an eye toward understanding how it would perform in different market environments. So you can use the variety of techniques, analytical techniques, to think about history as having various states of low growth, high growth, low inflation, high inflation, etc. Now, the fact is you only have one view of history. So it has a frequency distribution that may be quite different going forward, right? So one of the big challenges and one of the things that I feel is important to do is to really stress test the portfolio subject to very different view of the distribution of events going forward and seeing how would the performance of the portfolio change and can you effectively minimize the losses or minimize the really adverse outcomes given your particular type of allocation. In artificial intelligence, it's sort of evil agent problem. You want to essentially try to create an environment where your portfolio would do the worst and try to see if you can modify your allocation to mitigate that risk. So we don't necessarily take an extreme view of how the world is going to evolve, but we learn from the history and the states of the world to understand the distribution of the macro variables and the correlation among those variables.
If you were to step back and think about what that state of the world is, and this is not a Fidelity question, just if you were to think about the broad portfolio tilts and composition for U.S. institutional asset management, what does that real bad scenario look like? Whether it's policy or growth and inflation, what's that combination look like?
The initial market conditions play some role. So where we are today does matter. And what's amazing about the world today, and I'm going to get sort of the point of the maximum pain, if you will, going forward. So the recent events, the pickup in inflation, the pickup in commodity prices, the volatility pickup, What's interesting to me was somewhat surprising is how much the market has priced in these as ephemeral short-term events. And if you look, for example, 3-year oil is, I think, around $70, right? So the market believes that this is a very much still a transitory phase, and we're nowhere close to having a fundamental regime switch. So the pain trade for the market, and where I do think a number of portfolios would be challenged, is if we did get into an environment first that the wages are actually going to start to rise in a persistent manner. That's the first one that's really being investors have viewed with a lot of skepticism right now, and that would be one source of pain trade. The second source of pain trade would be if the interest rates, either long or short, doesn't actually matter, start to approach nominal GDP. I don't believe that that's really priced in. The neutral rates are not really priced into the market today.
Yeah, there's a couple of ways to look at that. Bloomberg makes it easy. They've got these tickers that allow you to look at the degree of backwardation across all kinds of different commodities. And I just was looking at it today, and across maybe 8 or 10 commodities, whether it's wheat, corn, soybeans, crude, nat gas, it's a lot of backwardation there on the order of between 5 and 20%. You look at break-even inflation, that curve is severely inverted as well, right? 2 years, 480, 10-year is considerably lower than that, maybe 200 basis points lower. So that's quite interesting that some recognition that this is here to stay, that this set of market prices is here to stay, is kind of an underpriced scenario that the market would have to grapple with.
Because we've had so many false starts. That's part of the challenge.
Yeah. We talked about commodities, and I'm certainly no expert in any segment of the commodities market. I know that the energy component of the S&P got really, really small there for a period of time, post the bust in 2015 and 16, and then certainly as part of COVID, that price bust as well. So at just the wrong time, commodities and energy equities have done really well, just as people's allocation to them, if you're anything close to an index weight, has been pretty low. Walk through just how you think about the presence of commodity-linked exposures in a portfolio going forward, just from an inflation standpoint, from a correlation to the normal risk assets that we look at, like the S&P.
So look, I'm going to also tell you I'm not an expert in commodities. However, most commodities, not all, but most commodities have had a very low risk premia if you look over very long periods of time. However, they were absolutely critical to own in times of rising inflation, or there were periods of time when it was quite profitable to own commodities. And the way I kind of think about commodities, I started out as a semiconductor analyst. And so in semiconductors, the life of a typical fab is about 4 years. So if you just look at the spending over a 4-year period, capital spending, you could get a pretty good idea of what the capacity and supply looks like. And then you try to marry that with demand, and you make bets when the supply is extremely high or extremely low relative to history. So if I just apply that same logic here, we have had a number of years, perhaps even a decade, of significant underinvestment in a number of commodities. If I look at arable land, it's been really kind of stable, or some parts of it you could argue even declining on productivity adjusted basis. So I do think the backdrop on the supply side is generally favorable. Now, that doesn't say anything about kind of how high the prices have gone. But if I believe that there is at least a chance for an inflationary environment, I do want to have a commodities or commodity-linked equities, at least as part of my exposure. And the only thing I would caution investors, having kind of lived through these periods, is inflation is insidious. It's really, really difficult to figure out what would be the source of that inflation. It could be a currency decline. It could be wage increases. It could be demand and shortage of commodities. It could be supply driven. It could be demand driven. So as I think about exposure, I think about having a portfolio of inflation sensitive assets. And I would like to have commodities as part of that. What would be another part? Let me give you a counterintuitive example. Historically, financials, particularly banks, haven't done all that well in the environment of rising rates because you tended to precede a credit cycle. In the current environment, there will be a period, if we get any steepening of the yield curve, particularly nominal yield curve, you could actually see some of the financials do quite well. And so that could be one small exposure within your inflation-sensitive portfolio. So building a multi-asset, inflation-sensitive portfolio that includes these different types of high inflation beta exposures is how I would go, as opposed to making a single bet on something like commodities or declining currencies or any of the other potential areas, or even tips.
Well, maybe we could talk a little bit more about inflation. Janet Yellen famously said the process was a mystery, which doesn't exactly inspire any confidence, but it really is. It's a difficult one for investors and certainly even central banks to have any real notion of where it's going. And of course, we've got all these very atypical shocks that have been introduced. The COVID shock and a very unfortunate Russia-Ukraine situation seems to be potentially an accelerant to inflation. But the Fed, after such a long period of time of disinflation and fighting inflation, that war from below 2% target, they went to this average inflation targeting regime. Some say at perhaps exactly the wrong time. Not their fault, but it seems to have been pretty poorly timed. When you think about portfolio construction and risk management, talk to us about the Fed and inflation, that interaction with the market.
This is obviously one of the biggest unknowns and one of the bigger risks to stress testing any of the portfolios. You touched on it. One of the things I struggle with when I think about inflation, and that comes from my background, is trying to reconcile the bottom-up indications of inflation, companies' ability to pass prices, companies' ability to source labor without increasing wages, with the top-down inflation is a monetary phenomena, right? So it's really difficult to get your arms around because the thing that connects them to some extent is anchoring of inflation expectations. Sort of like if enough people believe there's inflation, you will get inflation. And that's really, really hard to assess. So what we do when we think about the potential path for the Fed is try to see if there are sort of any boundary conditions. Are there any areas where the Fed is unlikely to go beyond? And the one where we're wondering about, struggling and trying to think through is what will happen to the financing costs if you actually start to raise rates significantly. Are you really able to do it, or will you need to sort of let the inflation run hot for a while in order to actually deflate the debt relative to GDP? So again, the Fidelity is a big firm and a lot of people have very different opinions and very different horizons and trade on very different signals. But in general, it's difficult to envision how the real rates would get back to, let's say, 1%. And so we're kind of thinking that, again, there are differences of opinion across Fidelity, but the ability to raise rates is somewhat limited by the outstanding debt and the potential to significantly increase the deficits.
It's interesting, if you just look at the yield curve and forward parts of the yield curve, it seems as if the market's already got the Fed tightening cycle in its crosshairs in terms of where it's going to ultimately land. And it's not all that far from 2.5%. So maybe you do that in blocks of 50 or it's a bunch of 25s. It is quite fascinating. I'd love to get your take on this. I'm just staring at the implied tightenings for this year. And now it's for December, you've got 8 full tightenings. And I think Citi came out and said 4 rounds of 50. So that would get you 8 in a short period of time. But boy, this was something that would be so far out of bounds even a few months ago, right? Even the concept of doing this much this quickly. And perhaps from an optimistic standpoint, the S&P is now only down 5% on the year. Tech has made a rip-roaring comeback. So perhaps the market's got more durability than we previously thought. How do you think about it?
Yeah, so look, if the real rates stay negative, you're in the expansion mode, it's probably a favorable thing for capital markets. But the flip side of what you just said, which is we're poised to increase the rates fairly quickly. The forward curve has already priced in, as you mentioned, 8 increases. 2-year rates are significantly higher. The flip side of it, we're doing that with the inflation print in the 7. So the implicit belief right now in the market is that 7 becomes 3 or 4, maybe lower, by the end of the year. And then we sort of kind of converge maybe to a 2.5. And in fact, while there's a little bit of a serial correlation in things like wages and cost of shelter, there's the serial correlation there that I think could persist into the middle of the year and maybe even further to the end of the year. But at the end of it, there is a common belief that the labor supply, the labor participation would rise, and the wage increases will start to subside. In my mind, the thing to watch to determine if that's going to happen or not is in part going to be tied to the consumer and corporate credit cycle. If we start to see a significant pickup in borrowing, I'm probably more on the side of seeing a longer persistence of an inflationary cycle. If we start to see a buildup of inventory and the need to build buffer inventory, we see some element of deglobalization. Those things may counteract the significant productivity gains we've had and could result in a somewhat longer inflationary environment. And so as we think about portfolios, having at least some exposure to the scenario of reflation is certainly warranted.
Be interesting to get your take as a former industry analyst on the corporate impact of inflation. You touched on a couple of elements here, but your input costs, and there's just such complexity in terms of the things that matter from an input cost standpoint to make things, labor costs. And then, of course, anything that's related to moving things around and getting things on time, the decisions that need to be made around can you or should you pass something through? These have got to be extremely challenging issues, and they don't seem positive for your average company.
My heart goes out to the guys and women who have the job of being chief procurement officers and supply chain management. That is not an enviable job in today's world. So the reduction of capital associated with inventory, the ability to outsource to the lower cost regions, has been a meaningful contributor to profit margins, particularly in manufacturing, but it's also been a source of productivity. So if you reverse that, or if you even forget about reversing, if you just halt the progress, it will have some moderate negative impact on the return of capital and potentially productivity of capital. It will create these sort of occasional disruptions that create shortages and allow, well, it will create substitution effects, but it will also allow some pass-through of pricing.
One of the things that you've said to me earlier was that a lot of the setting of the investment environment can be almost defined by this desire to avoid the last mistake. And I think about, as an example, the aftermath of the global financial crisis. We tried to move all kinds of things to exchanges. We wanted to get away from OTC derivatives. And that really changed the constituency and the buyer base in the U.S. risk-free asset. And that blew up, probably as some consequence of all of the leveraging of the treasury market. What are some of the things that come to mind when you think about episodes of avoiding the last mistake?
Whenever you have a philosophical statement like this one, it's important to understand the underpinnings, right? How robust is it? And a lot of that belief is really driven just by observation of financial intermediaries, right? And I don't want to sound cynical about it, but you will get fired if you simply repeat the last mistake. You may not get fired if you make a completely brand new mistake.
Right.
And by the way, also explaining to clients, if you just did something that went wrong, essentially you'll get punished for. As a result, we tend to see periods of overshoot followed by significant periods of undershoot. It happens with fairly high degree of predictability. So I think it was around 1972, we had the Nifty 50. And Nifty 50 was obvious bet. Why? Because scale begets lower cost. Lower cost gets you even more sales. And therefore, there was a virtuous cycle associated with large companies. And we've identified 50 of them. I forgot who it was. It may have been Payne Weber or somebody labeled them the Nifty 50. Now, once we found out that that wasn't quite working, the aftermath was, I think, almost a decade of massive outperformance by small cap stocks. And we were now no longer focused as much on that scale. In 1982, there was a pretty important paper published by Stanford Research Institute arguing that we're going to run out of oil. Needless to say, it was followed by 20 years of bear market in oil. And then, of course, Japan is going to own the world. 15 years of underperformance by Japan, 20 years. And the tech bubble. Tech bubble is getting back to more recent thing, was all about optionality of growth. And there was a positive correlation between volatility, implied volatility of companies and their valuation. So the more optionality you had, the more opportunities you had, the higher we're going to value you, right? And, in some perverse way, that's actually logical. And then the aftermath, we basically had blow up. The tech companies, many of them were trading at cash until about 2003. And the shift was, even after the tech started to recover, the mindset was no longer about growth optionality. Almost every company talked about their return of capital versus their cost of capital. Private equity started to take off, and then we had other things that started to happen. But this idea that we are looking back, we want to try to avoid the last mistake, and we start to lever up on whatever solution to the last mistake happens, such as offloading some of the refinancing risk onto the government as opposed to underwriting it. Those type of things, if they are taken to extreme, generally precipitate the next crisis.
Yeah, it really resonates. And I think we've seen some of that time and time again with these huge episodes of crisis where I think market prices become part of the narrative and they convince us of something. Anything that works for a sustained period of time also is going to attract a lot of attention and a lot of capital.
There are not shortage of people who recognize that, I think, as far back as the 18th century. And yet we keep doing it because it's part of the behavioral makeup of the markets.
One of the things that's been interesting the last couple of months, if you go back 3 or 4 months, you'd see in basically every asset class, volatility is up quite a bit. Rate vol, certainly crude, even gold, even FX vol, which has just been very sleepy for years. That one's even up. And of course, the VIX is higher. But Bitcoin vol is kind of close to its lows. It's had some big swings, but this has been an especially range-bound period for Bitcoin. It got very correlated there for a period of time to the triple Q. And it just felt like another risk asset. And some people were kind of poo-pooing the diversifying elements of crypto. Big picture, how you're thinking about it. And for a firm like Fidelity, the extent to which it is part of your thinking from a longer-term standpoint. Tell us in terms of your views on crypto. That'd be great to learn.
As a new asset class, I'll just make a few observations. I'm not sure I have really formed definitive views in all honesty, but let me make a couple of observations. So one of the things that I like to start with to understand the markets is, what does the market portfolio look like? Meaning, what is the market value of a particular asset relative to all of the other investable assets? Because it sort of gives you the implied return for that asset. And so if you look at crypto in aggregate, I don't know, there may be $1.5 trillion or so. And let's call the vol of that portfolio, 50 or so. You're now looking at something that on vol adjusted basis has the same sort of impact as, 3 times, 4.5 to maybe 5 trillion of equities. Idea being that on vol equivalent basis, it would be that big of a contributor to the aggregate market portfolio risk. That's a big number. And it does at least suggest that as an investable asset, it has to be considered. The next big question is, well, how do you actually think of it in terms of asset allocation, expected return, expected correlations? And in many cases, I don't think we had enough history to have a definitive point of view. I liked some of the ideas that treat crypto, particularly when viewed very broadly across different tokens, as early phase or early stage venture capital. And maybe you should allocate to it much like you allocate to early stage venture capital, particularly, again, if you exclude Bitcoin and include some of the coins where there is a bit more of a linkage between the value of the services provided and the value of the token. However, in such early phases of this, at this point, been a bit more of a preference, if you will, on the part of the investors that see it as a source of significant optionality in the market. But I don't yet have a point of view, although again, within Fidelity, some people do and some people don't. So I don't want to speak on the behalf of Fidelity. But personally, I'm still kind of in the early stages of trying to figure out how to think about the correlation structure going forward for this asset class. But it's big enough that I do think it has persistence and it will be around for a while.
It's been fascinating for me to focus on derivatives and option pricing to watch the nascent but growing marketplace in crypto and Bitcoin and look at the changes in the volatility surface. Boy, there's just a lot there. There's a lot of opportunity to create new structures that effectively monetize certain parts of the volatility surface, perhaps use some of that premium to buy hedges. It's really great to see the development of liquidity, because that really just opens up opportunity for different investors to become involved in the space in ways that is suitable for their own risk reward. Everybody's got a different way of coming at it.
And, you've obviously seen a lot of people pursue different type of outcomes, right? Some invest on the basis that this will be a store of value. Others are engaged in lending and staking as a source of income. Yet another group is involved in the venture capital side of it, thinking of it as an optionality play. And so, yeah, it does at least open the door. Although, again, I personally am still in the learning phase of trying to get my arms around it.
We touched on it a little bit earlier, but I would like to get your take on the very sad and unfortunate developments in the Russia-Ukraine situation, just with respect to markets and inflation. How are you guys thinking about that?
Yeah. So, like I said, I was born and raised in Kiev, so it has a particular relevance. If I think about crises more generically, bubbles, crises, unexpected events, I kind of have a very simple framework for thinking about it. What's been the impact on valuation? What's been the impact on expectations as implied in positioning and derivatives, etc.? And what is my view? Has it fundamentally changed the real economic outcome? And also, the one thing about the crises, what makes them so challenging is that the information gets incorporated pretty quickly and extremely. And so you get dislocations, and then you're now trying to figure out, has there been sufficient capitulation? So in this particular case, what's been remarkable to me is that dislocations outside of, let's say, European banks and maybe a couple of other areas, the dislocations have been quite small. And that's what I mean by investors do not seem to be pricing in permanence of this, whether it's the commodity markets being in a severe backwardation or even the long-term vol rising, but not as much as one would have thought, given the tail risk associated with the recent events. And so in many ways, I don't like to react into the crisis unless I can convince myself that the valuations and the sentiment are now so extreme to the capitulation side that the fundamentals, which are unpredictable and unknowable at this point, give me a very high chance of winning. I want that favorable convexity. And there are very, very few things in the capital markets today that have been directly associated with this event that actually give me that type of convexity. So in most portfolios, we have not made significant changes. People made changes on the margin, of course, but overall, the pricing in the market has not changed significantly, and that has tended to drive the outcome, the activity.
One of the things you talked about as well is time horizon.
Yeah.
And how important that is. And it's individual, either by investor or certainly by firm. And you've said it's a function of how you hire for different strategies and even for investor communications, which I thought was really interesting. I'd love to hear you talk a little bit more about how you think about time horizon.
It's a little broader. If you don't mind, to put it in slightly even broader context. I really, really strongly believe that becoming a good investor is very much about self-awareness. And when I think of myself, the way I've grown up is I've always pursued jobs or opportunities that one would say were very difficult or impossible to do. And I did it not out of sense of arrogance. In fact, it was quite the opposite. I did it out of sense of profound insecurity. I just figured that if I try to do something that's impossible, if I fail, nobody's going to blame me. And if I succeed, wow, that's a huge reward. So I always pursued opportunities that had that sort of desirable convexity. I think awareness of who you are and awareness of what you're good at is really, really important. So, for example, the type of an individual who's a phenomenal day trader or has a horizon of 2 or 3 months, their skill set is going to be completely unrelated to somebody who is a deep value buyer. Deep value buyer has to be willing and able to withstand incredibly negative headlines, incredible degree of pain, market telling him or her that they're completely wrong, that they're an idiot, and have a confidence to withstand that because they know that they have favorable convexity and that they are going to be right. If you're going to be a day trader, you don't have that luxury. You've got to close out your position every day, and therefore trend following, liquidity sourcing, being liquidity provider, anticipating liquidity needs, takes precedence over some of these longer horizon ideas. And so what I found, for example, in equities, people who make terrific growth investors tend to be very different from people that make great value investors. Why? If you look at signals that help you identify growth stocks, the momentum tends to peak at around 9 to 12 months. So they tend to harvest alpha. They tend to trade around the positions. Whereas a deep value investor, alpha tends to be 3-year in horizon, a 5-year in horizon. It's very different. Great growth investors have to have tremendous sell discipline. They need to harvest because the mean reversion will eventually hurt. Whereas a great value investor has to be really careful about entry point because valuation will get them out. That's the easy part. But figuring out when there's been sufficient capitulation in the market, that's hard. And that's part of the art. And also capacity in short horizon strategies tend to be much lower vis-a-vis long ones. But the thing that's so important when you start to manage a money management business and you start to think about delivering a good investment outcome and a journey that keeps people invested, that's when it's really important to start thinking about integrating strategies with different horizons. Because in my experience, time horizon diversification is one of the most robust and persistent sources of diversification, meaning that the returns of a day trader will always be uncorrelated with returns of a distressed debt buyer. And combining those type of different returns is critically important to delivering persistent, robust diversification.
That's a fascinating insight. I had never really thought of it that way or seen it framed that way. So you're saying that there's actually diversification from the types of time horizons or the length of time horizons that are pursued by different strategies.
Because the anomalies are different over a short horizon versus a long horizon. Now, the more pedestrian, obvious example of that has been historically value and growth, right?
Right.
Growth has 9 months, the value is longer. Now, the problem was in '08, which is a lesson learned. There was expected to be negative correlation in the alphas of value and growth strategies. But if you looked at the universe of stocks that were very deep value in '08, and you looked at the universe of stocks that were very growthy in '08, they shared one common characteristic that had very high market beta. And so when the market turned down in 2008, a lot of the portfolios that was supposed to be diversified ended up going down together because of the common risk exposure to beta. As we pursue this type of portfolio construction, diversifying time horizons, it's very important to make sure the common risk exposure and unintended exposure is managed carefully. Otherwise, the diversification is not going to work.
As we close out the conversation, and I do want to thank you for taking the time to do it, what are some of the things on the docket of research projects that you are looking at and are excited about? What does that look like?
There are a few things that I think are going to yield significant benefit and have inherently high return on investment. First one, we are working to apply some of the lessons from AI and machine learning to developing better trading strategies. Not so much for standalone products, but to enable our existing products source liquidity more cheaply and deliver lower transaction costs for our clients. The second one is the one we touched on, which is how do you really gain confidence around being able to deliver diversifying strategies for a 60-40 portfolio. And there are a number of venues in which we're going. But one of the things that troubled me is that as I looked in the marketplace, a number of strategies out there that are supposed to deliver diversification actually have a pretty significant exposure to market beta, both to duration and to the equity markets. So how do you actually build something that can be dynamically adjusted to make sure that you're delivering diversification through time that captures and mitigates any buildup of common risk? Looking at it from both fundamental and quantitative basis is an area I think has a lot of promise and something that we're definitely looking at.
Well, diversification is going to be so critical until further notice, it seems. So I think this is time well spent. And this has been time well spent too, Vadim. I really appreciate you spending the hour. Our guests will value the conversation. So thanks for being a guest and sharing your insights.
It was my pleasure. Thank you so much, Dean.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback. As we aim to utilize these conversations to contribute to the investment community's understanding of risk, your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.